money management, it's such a critical issue. It basically separates the winners and losers. In fact, it's been shown that if you give 100 traders a system, the same system, a system that's proven to have 60% winning odds, that's still, out of those 100, you're going to get 90% losers. And it just basically goes to show you that money management is the key there, because a professional trader will be able to take a winning strategy and work it well. Even a 50% strategy, a great trader can turn a 50% strategy into a consistent profit. Poor money management is what kills most traders, and a lot of traders just don't understand how it is. Once we get everyone listening and on board, if you guys have any questions, just type them in the chat. I will get to them ASAP. All right, so let's go ahead and get started. Is money management really that important? Yes, that's the answer. End the webinar. That's all you need to know. Yes, it is. It really is that straightforward. Yes, it is that important. Of course, we're not going to end it here because we have a lot to cover, but it is extreme important. In fact, there is no holy grail in trading, but if there was one thing that is as important, say, as the holy grail, it would be money management. While we're trading, we're always looking for that edge. It's the whole reason why systems are even developed, because we want to develop that edge. We want to get a 70% or so profitable system. That sounds like a pretty good edge to me. But see, the reason we need proper risk management is because even if you have a 70% profitable system, that means out of 100, you're going to lose 30 trades. So the problem is you're going to hit a losing streak at some point. You don't know if you're going to hit those 30 trades in a row. You don't know if you're going to hit those 30 losses spread out over the 100. You could hit your first 30 trades losers and then still have a 70% by hitting the rest. You could hit 70%. So you don't know where your streaks are going to come from. So because of that, it's truly important to risk small amounts. Because if you trade too much, you overweight your account. You could hit a losing streak, which, by the way, is well within the parameters of your strategy, and you could get, margin called or have such a huge drawdown that would be almost impossible to get back. It's not a sexy topic, but probably the most important concept in trading. And again, like I say, it's easy to understand, but really difficult to apply on a day in, day out basis. Even professional traders know, they know that they're going to have a streak, and they have losing streaks. So they know to keep their percentage low, and this will allow them to weather the storms. In fact, it's pretty much like this. If you're not using money management, you're basically gambling. Even if you are a gambler, if you met a professional gambler, the successful ones have money management systems. So they're straight up gambling, which is a situation where the house has the odds. So professional gamblers that are successful do it with good money management. Now we have an advantage. We actually can find high probability setups and wait for stuff that's in our favor. Now if we can combine that with good money management, then we can have a very lucrative career as Forex traders. All right, so what's the first rule? Survive. That's it. If you can't survive, you ain't getting further than that, right? Survival, the basic need. That is number one. It's okay, that sounds simple. How do you survive? Well, like I say, you risk only a small percentage of your account per trade. This gives you a chance to learn, to stabilize. You start coming in, you start learning a new system, you get on demo, you start averaging your 20 pips a day or whatever your target is, daily target if you have one. As soon as you go live, you start, you got $1,000 in your account or 2,000 in your account and you're trading one standard lot. One loss at $200, you just lost 10% of your account. Risking a small percentage of your account per trade is the number one key. And when I say small percentages, in Forex, small is actually big. You know, with the leverage we get in Forex, 100, 200 to 1, I know the NFA rules are trying to push it to 50 to 1. If they have already, you know, you find your work on that. But even with 50 to 1, this is great leverage. You know, with just small percentage of risk, we can multiply our accounts several times each year. But the danger of risking too much percentage is massive drawdowns. Now I want you to take a look at this chart, if you can. What we see here is a trader trading a 2% versus a 10% trade going through a bit of a losing streak. Okay? So starting with 20,000, a trader risking 2% per trade can preserve his capital for a bit longer than a trader risking 10%. You can see that there's a big difference between risking 2 of your account compared to risking 10%. If you happen to go through a losing streak and you lost only 19 trades in a row, I mean, that's a pretty steep losing streak, but it's happened to the best of them out there. You would have went from starting with 20 grand to having 3 grand if you risked 10%. That would have been over 85% drawdown. But if you had properly used about a 2%, after those 19 trades, you have about 13, almost 14,000. Okay, so you would have lost a lot less, somewhere in the realm of about, 40%? The last thing we want to do is lose 19 trades in a row, but even if you only lost 5, say, I mean, look at the difference between risking 2 and 10% after 5 losing trades. If you had only risked 2% of your account, you'd have 18,447. But look, if you risked 10%, you'd only have 13 grand left after 5 trades. Right? I mean, if you would have more if you risked 2% and lost 19. You'd still have more after just 5 losing trades on 10%. All right, so you got to protect yourself first. I say that all the time in the daily sessions. Protecting yourself first is important. I mean, you're going to have mistakes. Everyone does. I mean, the idea is to train yourself like a machine, but we are human. So that training process is a slow process that develops over time. And because it's a slow process that develops over time, all the more reason to keep your risk percentage low, because you got to give yourself that time to get comfortable with the market. All right, so as I say here, what we're trying to do here is become skillful survivors. Okay, that's it. We want to survive with skill. And to develop this skill of survival, you must practice one virtue persistently. Okay, that's discipline. Discipline is probably the most overused word in Forex trading education. Hands down. Everyone talks about discipline. Got to use discipline. Got to use discipline. But it's, you know what the funny thing is about discipline? It's one of those things that the true meaning cannot be conveyed with words. You know, I hate to say it, but discipline comes through practice and through, I want to say mentorship, but through a role model in a sense. You need to watch somebody that is practicing good discipline. You need to be with someone that is practicing good discipline, because it's really hard to pick up on what discipline truly is by reading it out of a book. The nature of discipline is basically doing what you don't want to do because you got to do it. All right, so by nature, it's not pleasant. All right, so I mean, despite the cliche, it's still the most important thing you can master. It's basically the ability to plan your trade, but then trade your plan. That's where the discipline comes in. A lot of people can plan the trades, but to actually trade it according to the plan is where the discipline comes in. You know, it's kind of like, you know, eating healthy, exercising, dieting, working out, you know. It's something that most traders talk about doing, but few of them actually practice it. Will they give it to you there? They give you some discipline in the Foreign Legion key. So again, like I say, just like we were talking about eating healthy and staying fit, money management, it seems like a burdensome activity. It's something you really have to practice. And the problem is it's a slow beginning. So because it's a slow, sluggish start, it's very, it tests your patience to practice. No problem, Martin. Got you, man. So, it's a difficult thing to do. It's a discipline. Once you develop it, you'll be able to execute your plan without, taking yourself out because you're uncomfortable with the risk. It's the ability to continue your methods even after you've suffered a loss, per se. Or it's the ability to stop trading after suffering a loss, even though your emotions want you to jump back in and make that back. So it's a matter of conquering those internal emotions, okay? And and this, I'm just going to spend a second on this discipline because, as I say, I could talk till I'm blue in the face. Does that mean you're going to be disciplined when it's all said and done? No. All I can do is kind of point you to the area inside. You're going to have the feelings that are going to want you to continue. But the thing is if you're doing something that's not explicitly outlined in your trading plan, in other words, you have a 15 pip stop, but you're minus 25, okay? At that moment, you're letting your discipline slip. Okay, if you've already hit your daily stop loss, if you're down 30 on the day and you enter another trade, okay, that was you not controlling your emotions. That was poor discipline. Okay, so we'll talk about it a lot because we have to, but it's going to come through consistent practice on your part. It's up to you. Of course, we're always here for you. I'm always here for you when when I'm online as a moderator. I'm definitely here for you if you have questions or and we all make mistakes as well. We are humans, and it's an ever-going journey, this whole getting your discipline fine-tuned. So you're never there. You're always getting better. All right? So that's just a little touch on discipline. Next thing, which is very important when exercising a risk management strategy, is using stop losses. Okay? Stop losses are absolutely necessary. And for those that are experienced traders, I'm just getting through this basic stuff here. It is very important. It's not talked about enough. And even when it is talked about, it's usually swept under the rug as soon as you stop talking about it. So I know at first you're like, I know what a stop loss is. Well, I'm going to try to give you a different little perspective on it. And then we'll get into the specific money management techniques that I use. But stop losses are important. They are absolutely necessary, okay? If you're not using stops because you think everything comes back eventually, you are dead in the water. It's just a matter of time. In fact, if something happens and you're in a trade and you have, say, a 20 pip stop, and it goes against you and you're at your minus 20 and you don't get out and it goes minus 25 and you don't go out, it goes minus 30, 35, then you're telling yourself, all right, well, we'll turn this into a long-term trade. It's got to come back. That thought right there, that's a disciplinary issue. But that thought is a very dangerous one. No matter what the outcome of that trade, it's very dangerous, and I'm going to tell you why. First, if it doesn't come back, well, that's obvious why that's a disastrous outcome. You just lost your trading account because you will be margin called, especially if you weighted your account for a 20 pip stop and then you're running at 100, your account will get blown. The other worst case scenario, because the only two things can happen is you can either lose the trade or win the trade. They are both worst case scenarios. In fact, winning the trade is probably the absolute worst thing that can happen to you. If you ignore your stop loss, you hang on, you go deep drawdown, and then it comes back and you exit for a profit, you have just solidified, exactly, Omar, a bad habit. You have just told your subconscious that it's okay to do that. And now you've actually taken the decision-making process away from your conscious mind. Don't think you can do something like that and then tell yourself, okay, this is be the last time I do that. I guarantee it won't be. Yeah, yeah, it's true, and that's true. And if you have to hang on to it long enough, you could get hammered on the swaps. Exactly. So it's not a good practice to have. Absolutely not. You will be dead eventually. And that's a side note. We're all going to die, but that's not what I meant. Your account. There's different types of stop losses. You can have stop losses per trade, which is absolutely necessary, and then you can have stop losses per day. I also think that's equally as necessary. I think that if you lose a certain amount per day, it does something to your psyche. Um, that it's going to be very difficult to look at the market with an open mind and an unbiased view. I think there's emotions. Once you're down an uncomfortable amount. So if you have a daily stop loss of 20, so you don't want to lose more than 20 pips a day, and you're down 35 on the day, you got to think about what opening that next trade could do. If you take a hit on that, you could be down 50, 60 pips on the day. That's could be a week's profit right there. So you got to think about what it's going to take to get it back, okay? But if you're a seasoned trader and you know how you react emotionally to losses, okay, then maybe a daily stop loss is not necessary for you because you can identify good setups regardless. Okay, you could probably, as long as you have your per trade stop loss, then it's probably acceptable. But the danger is this: when a trader draws down 5 to 10% in a session or on a trade, and you get that make it back mentality kicking in, and it causes you to maybe over leverage your next position, maybe go a little heavy, so if you just get 10 on it, it makes it up. But that exposes you to even greater damage, possibly margin call. Yes, good question, Pam. Excellent question. Pam asks, what's your opinion of noting the stop mentally, okay, and watching the trade to exit when and if it hits your exit point or your mental stop area to avoid getting triggered by the broker? That's okay. All right, now there's a couple things you raise in that question, Pam. It's a great question. First, yeah, you can have mental stops or physical stops. The difference, physical stops, you enter into your broker. The broker sees it. Everybody knows it. Okay, it's there. The mental stop, it's up to you to exit that trade at the proper time. I use mental stops. Okay, there's pros and cons to both. I should have a slide on this, but since we're just answering the question, we'll go with it as best we can. Okay, a hard stop, excuse me, or a physical stop, a hard stop when you enter manually is the best for actual management of risk because you know exactly what you're risking. And you're going to put the stop there, you're going to get taken out at your stop level. So you know you put your stop at 20, you're going to lose minus 20. Now, I use mental stops, but the reason I use mental stops is not because I'm afraid of the broker like falsely triggering me or something like that. And I'll talk about that whole stop hunting situation, or at least my perspective on stop hunting. But for now, the reason I use manual or mental stops is because I watch my sidecars, for instance, and I know, say we're looking at the grids, and I'm using a 4-column roadblock as my stop loss, then I'm looking at my sidecars and say there's a 4-column resistance and that's my stop, and now we're bouncing up against it. So I'm minus 18, minus 20, my stop's at minus, my mental stop is at this level, minus 20, 21. If it breaks this level, I'm going to get out. Okay, but say it pops over it by 1 or 2 pips, yet my sidecar, okay, say I'm in short euro dollar and I'm looking at euro yen and I want euro yen to do what euro dollar is doing. So I'm short euro dollar, say I'm over my stop by a pip or 2, but euro yen happens to be holding under its resistance level. So I'm going to hang on to euro dollar until I see what euro yen does. If euro yen holds and starts moving lower, then euro dollar should pop back under the resistance level. Now a hard stop that would have been taken out. If euro yen, say the sidecar goes against and euro dollar keeps going, then I'll get out. The disadvantage, it costs me a few more pips. So say I had a 20-21 stop, I might take a 25 stop on it just to make sure. But the number of minus 20s I've saved by doing that makes up for it in the long run. You know, the hard stop lets you manage your risk more precisely. The mental stop gives you a little more leeway, but until you really understand the sidecars, I would not use mental. I would use physical stops. Also, if you have a problem, the other problem with mental stops is this. It's up to you to click that button to get out. So you have to go through another emotional exchange internally. So first you put the stop in at minus 20, 21. Now you're at the mental area, 21, 22. Now you have to decide to go ahead and take it. All right, that's another issue that's not easy for new traders. So if you're unable to get out at your proper stop loss and pull that trigger, because taking a loss is very difficult to do but necessary, then you should be using hard physical stops. That's right. So if you're having a problem and you're letting your stops too loose and it's costing you too much in the long run, use hard stops. Okay? Now, this webinar is not going to tell you where to put your stop. Okay, Baron? Should your stop be based on your system? Absolutely 100%. Base it on your system. Even if you're a Fibonacci grid trader, which most of us in this room are, even among us Fibonacci grid traders, we have different styles within us. And two people in the same trade might have a different stop loss based on their individual style. So, but the grids, you know, the good thing about dynamic Fibonacci grids is they do tell you where the stop losses should be based on what your risk tolerance is. Okay, and Chris is saying probably a security stop loss would be necessary at least if you lose connection. So a lot of people put like a 30 pip disaster stop, giving them room. Okay, they want to have a 20 pip stop. They'll put a 30 pip disaster stop in case something happens. But the problem is this too. Sometimes you realize that disaster stop is there, so you let your stop kind of go a little bit, and then if you start finding out all of your stop losses are being hit at your emergency stop loss, all right, then we may need to rethink that too. All right, so you don't want to use the emergency stop loss as a stop loss. It's there only for emergencies. So if you've got a minus 30 disaster and you keep getting minus 30s, well, then maybe we should just use hard stops. Okay, now another thing about stop losses, this is how I like to look at stop losses. Well, first let me say this. If you put restrictions on your stop losses, say a daily stop loss of like 2% of your risk, you guarantee that the same thing will not happen to you that happens to 95% of the losing traders out there. Most losing traders out there lose because of one trade, one day, one session. A lot of them will be great. They'll get some consistency down, but when it comes time, you know, you're getting your consistency, you get that one trade, time to get out of a trade, you don't do it, you think it's going to come back, and it takes you out. All right, this is what happens to most traders. So by having this a daily stop loss, you ensure that one session or one trade doesn't end your career, basically. And that gives you a chance to be successful. You take yourself out of the 90% group just by having a daily stop loss, just by stopping when you're down a certain percentage. I'm going to use the example of 2% per day. If you lose more than 2%, stop. It's not fun. It's not easy. You want to make it back. Trust me, I know. I've been there plenty of times. And still, you know, I took a pretty good hit yesterday on the board. So I'm still trying to get that back. So we all, you know, make mistakes. But it's important that your discipline kicks in, and if you're down 2%, you're like a computer switch. Or a machine. You just switch the machine off. Go enjoy your day. Do something else. Do the best you can. Go meditate. Get out of that frame of mind that caused you to lose, and come back another day or another session. At least wait a whole session to come back. And do something else. Get your mind completely off Forex and engage in something. If you got kids, play with your kids. If you got a job, do something for your job. If you're in school, do some homework. If you like video games, go play video games. Get your mind completely engaged in something else before coming back for a good time. I say at least 24 hours, but especially if it's a big hit. But you know, if you can do something and come back, you know, the next session, that's up to you. All right, that's important. Now, here's a good way to look at a stop loss. Now, you have a business. We have a business. We're all currency traders. This is our business. We must treat it as a business. okay? All businesses need a certain thing that no one likes. We all need it personally as well, and that's called insurance. No one likes paying insurance premiums. Everybody hates it, especially like health insurance. I mean, we need it. Don't get me wrong. We like to have it. It gives us peace of mind. But, you know, chances are you're paying out the yang for it. Excuse my French. Excuse me to all the real French people out there. That's not French at all. Um, but, you know, car insurance, health insurance, we pay all these premiums and then we never even use it. But guess what? As soon as we don't have insurance, that's when disaster strikes. What is the purpose of an insurance policy? It's to prevent that one disastrous outcome. Okay, like the hurricane on your house or the earthquake or you know, God forbid, the car accident, a devastating accident or a sickness, a disease, something devastating, okay? That's what insurance is for. So when you exit at your stop loss, a good way to think of that is you're paying an insurance premium. You are paying that 20 pips or whatever your stop loss is to ensure that the disaster doesn't happen to you. All right, so just think of it as you're paying insurance. It's a business expense. Does that make sense? Because I think that if you can look at it that way and you have a business mind, that you'll understand that some businesses have expenses, these are yours. Now think of it this way. If you take higher risk, just like insurance, if you're a risk taker, guess what? You're going to pay higher premiums. If you're more conservative, you're going to pay less premiums. You're going to get stopped out less with more conservative entries. If you're higher risk, you're going to pay higher premiums in the form of more stop losses. All right, so very important. Okay, I don't want to belabor the point. Good question, and Drew, you just brought it up, stop hunting. Okay. Here's the thing with stop hunting, guys. All right? No broker is going to try to move the market to take your lot out. Whatever you got on it, I promise you it's a drop in the bucket, if that. No broker is going to waste their energy moving a market to take you out. Okay? Here's the deal. What they do see is they can see your stop, but the truth is they don't care about it. What they do see is stop clusters of stops. If they see a grouping of stops in an area, it might be worth it for them to try to counter the trades to hit those stops, because if they hit those stops, it'll accelerate the trend in the broker's favor. Okay? So if they are targeting a group of stops, it doesn't matter where your stop loss is at, if it's on or not, because you're not, if your stop's at minus 20 and they're targeting a cluster of stops, what's around minus 30 for you, if you don't stop out, if you didn't have a hard stop and you let it go and you let them run it against you, then what? Then you're caught. And you're caught in them moving it into the stop losses, which is going to accelerate the trade against you. So here's the deal. Don't worry about stop hunting. You really can't do anything about it. Now, technically, if every trader used mental stops, then at that point, the brokers would have no way to see where the stops are. So you can say, okay, I'm not going to put my stop in because I'm doing my part for the rest of the traders to make all of us invisible. But the truth is, and that's fine and understandable, but be careful. Well, you know, Corey, basically, you know, here's the thing. I mean, to move it any major distance, yeah, but, you know, a broker could, and a lot of times it's brokers, it could be banks too. You know, it could be banks because banks see all the orders too. The banks can do this as well. But see, here's the thing. They can move the market for short periods of time for short distances. So a broker could probably move a market maybe 10 pips, 15 pips. If that is good to hit the stops on their books, then they can probably get another 20 pips out of it or something. I'm throwing stuff. This is what a broker could do, possibly, a big broker. Now you get a bank involved, they can move at 50, 100 pips, because once the banks get involved, then other people jump on board. And that's the thing. If one broker can hit some stops, they can trigger. They're playing a different game than we are. They're making waves. They're playing poker. We're making side bets. We're just riding the waves they're creating. So, if they create a wave and other brokers get wind of it and they join in, they could create a mass movement. But still, it would only last for a short period of time. Exactly, Baron. That's exactly what I'm getting to. So, ignore the fear of stop hunting, okay? Just trade your plan. A consistent strategy will still pay off. You're going to get stops, and you're not going to know why some stuff didn't work out for you. Remember, you have a winning strategy wins 7 out of 10 trades. Well, that means you're going to have 3 good setups out of 10 that don't work. A couple of those could have been stop hunting or could have been some unexplained phenomenon. But that doesn't matter. Just trade your strategy that works, and then over the course of several trades, you can go back and see how it's working. And you got a good point there too. If you get caught, if you don't have a stop and you get caught in the wrong way in a fast-moving market, you may not even be able to get out. So, if you are having an issue with stops, then yes, I would absolutely use hard physical stops. Okay. Any more questions about stop losses? Your risk to reward ratio. You want to know what you're risking before you get in. You want to know where your stop is before you get in. The least acceptable risk to reward is 1-to-1. What does 1-to-1 mean? It means you're risking a pip to make a pip. So you're risking 10 to make 10. You're risking 20 to make 20. You've got a 20, for every 1 pip of stop loss, you have 1 pip of target. Okay, so basically you need 50% to break even with a 1-to-1. If you have a 1-to-1 risk to reward, then you're winning 100, losing 100, winning 100, losing 100, whatever it is. You got to be more than 50% to be profitable. Now, if you have a poor risk to reward ratio, say 2-to-1, in other words, you're risking 2 to make 1, so you have a 20 pip stop for a 10 pip target, then you basically got to win 75% of your trades to be profitable. So what we want to do is we don't want to risk more than we were going to take on a trade. Now, we're scalpers, so sometimes, it doesn't always work out this way, but you want to be as close to 1-to-1 at the low end, and you want to be 3-to-1 on the, or 1-to-3 on the high end. All right, so here's an example of 1-to-3. All right, say we have one standard lot, and we're trading 10 pip stops with 30 pip targets. Okay. Now here's a trader that hits 50% of his trades. 5 and 5 winners, 5 losers. All right, with proper risk management, 5 losers, you lose $500. 5 winners, $1,500. So 50-50, yet he's up $1,000. All right, so risk to reward, it's a very basic concept. You just want to make sure when you're getting into a trade that you're not going to risk more pips than you plan to make. All right, it doesn't make sense to risk 100 pips to make 10. Why? If you win 10 times, okay, you've made 100 pips, but guess what? You lose once and you give it all back. So, I mean, you've got to be spot on 100% really to be profitable. I mean, 95% basically to be profitable with a poor risk to reward. All right, so if you trade with a good risk to reward ratio, your chances of being profitable are much greater, even if you have lower win percentages. In fact, if you had this 1-to-3 risk to reward, you could actually, if we only won 4 trades and lost 6, the four winners would be $1,200. The 6 losers would be $600. We'd still be up $600 and losing more trades than we won. All right, so that's a quick bit on risk to reward. All right, so I mean, basic money management strategy consists of discipline, consists of stop losses, proper risk to reward ratio, and a plan. All right, now, so we need to get into a plan. This is a plan that I use, what I like. Now, you can adjust this plan however you like. Okay, this is, I like to use this plan. I've kind of modified it myself. I've heard, 20 pips. I've heard people talk about, hey, 20 pips is all you need. And sure, I can see it. I mean, 5 pips. If I knew I could get 5 pips every day, 100% of the time, I would do it. But nothing's 100%. So why 20? Well, the problem I've noticed with many traders is, you come into Forex, you think about how many pips you're going to make, and they see people, you know, making 100. You hear George Soros breaking the bank, and totally killing the sterling and single-handedly making billions of dollars. And, people think that, and they get involved with that mentality. And it's dangerous because it's not, it's so rare that that kind of stuff happens, that to think that that's possible is somewhat naive, you know. Um, so, once a trader wins, he gets a good trade, it feels good. You want to keep going, so you keep trading. In fact, most traders do not stop after a winning trade. In fact, most don't stop after a losing trade. After a losing trade, they want to make back that recent loss. And in that attempt to make it back, sometimes you lose again. And then you want to go again. The motion gets different. Sometimes you only quit when you've reached such a low point that you're basically sick to your stomach. And so secretly they're trying for those 100 pip days, and in doing so, they may have been up 30 or 40, but because they didn't want to stop, they gave it all back. And usually most traders will just trade until they're in the negative so much that they can't take it anymore. It's really hard to get a trader to stop positive. So, just like any successful business, I think it's important to have goals and targets, if you will. Yeah, I'm telling you guys, it's not pleasant. That is not a pleasant feeling in your gut sinking there. But we all go through it. In fact, that's the real way to learn. You got to go through it. And that's why you need to start off, again, to low risk percentages at first, so you can stomach some of these losses and still be in the game. But targets, I think, are necessary to run a successful business. Now, nothing's mandatory, but they're guidelines. Your goal doesn't have to be 20 pips exactly, okay? It can be whatever your strategy, your style can consistently produce. Some people are really good at finding pips and they can do 30 a day. Some people are just good about doing 10 a day consistently. And that's what's important. It's what you can consistently achieve. And that's what it's all about, guys, is consistency. Not how many pips you can make today, not going for that 100, but what can you do every day? That's the most important thing. That's the key to making a career out of trading. Consistency, again, is what we're here to talk about. I like 20 because, I can get it most of the time. I can get it out of the 5 days of the week, usually 3 days a week. But even if I don't get 20, I'm around 10 or 15 or so. It's easier to get 20 than it is to get 40. I've thought about making 40 a goal, but shoot, I got to get 20 twice to make 40. So why make 40 the goal? I could just make 20 the goal, and it's easier goal to achieve. So, these goals they help you with your discipline in a sense. So, getting 20 is easier to getting 40, but why not get 5? Because I don't go for 5 because the risk reward. I mean, 1-to-1, I mean, a 5 pip daily stop. I mean, that's just not realistic. So I got to give myself room to breathe. 20 is right there. So that works out for me. These targets help with your discipline because they're clear areas to stop trading, and they take an element out of motion out of the trade. You get, okay, 20, done, I'm done. You don't have to think, should I keep going, should I not keep going? If you close a trade and you're up 23, you stop. All right, how many times you had a great day trading only to take that last trade and it brought you back to break even or even negative? It's annoying. So if you just stop when you hit a target, boom, day's done, that's a tally mark, you move on to the next day. No, not minus the spread. These are actual pips. Actual pips, Baron. All right. So the whole point of this presentation is going to show you the power of making 20 every day and what it can do for you. okay? It's better to be consistent at a small number of daily pips and then gradually increase your lot size as your account grows. Okay, so just get good at 20. Get good at making 20. Do that every day. Make that your job. Forget about being a good trader. Get good at making 20. Once you can do that well, then who cares what the lots are behind it? You can just slowly, gradually increase. You average 20 with a standard lot. You grow your account with it. When you're consistent, move up to 2 lots. Okay, doing the same thing. Now keep doing what you're doing at that new level till you're comfortable again, and then you move up to 3 lots. Never doing anything more than making 20 pips a day. You don't have to make more pips. Making more pips is harder. You got to find more opportunities. You got to stay in the market longer. Okay, I'm talking about doing the same thing day in, day out, and behind the scenes we can scale up what we're doing. Okay, so I choose a pip total that is attainable daily and still allows me to practice good risk to reward. Allows you, so that's why I don't do 5 pips because, it's not worthwhile. 20 is a lot more reasonable. Plus, you can make 20 pips in a couple hours, sometimes minutes, and you don't have to watch the market all day. Okay, so making 20 pips is the vehicle. All right, now let me show you this next example here. Now this is 20 pips is all you need. This is non-compounding, okay? Say you got a $10,000 account. You want to trade 1 standard lot for 20 pips a day, and at the end of that week, you want to take that money out. So every week, you're starting with 10 grand again. You're not compounding, all right? Just for pure income, okay? 1 standard lot, 20 pips, it's $200 a day. That's $1,000 a week. That's 50 grand a year. So with a $10,000 account, you can make a $50,000 a year income, and that's pulling your money out every week. No compounding. Okay, and you can see the chart here. 2 standard lots, $100,000 a year income. You can trade 2 lots for 20 pips a day. That's 100 grand a year. Again, that's income. That's not compounding. Once we get into the compounding, you'll see the numbers are astronomical. Okay, you can see if you can get up to 5 standard lots. 5 standard lots takes about a $50,000 account to do. About a $50,000 account to trade it properly with 2% risk management, and that gives you a $250,000 a year income. So you're making 5 times your trading account per year, okay, with just 20 pips a day. That's it. All right, now this is obviously a perfect world. I mean, you can look at it like 100 pips a week, however you want to break it up. All right, and you're not going to be perfect, but if you're in the ballpark, you're going to be doing just fine. All right, so that's a quick chart on non-compounding. That's purely incomes. If you need income and you've got an account size and you get good at making 20, this is your chart. Okay, but a lot of people are going to want to grow an account. All right, and that's where compounding comes into play. All right, so how much do I risk? How do you know how much do I risk? Okay, first you have to determine what's acceptable for you. All right, now we already saw that initial chart on what 2% drawdown can cause, what 10%, I mean really 1 to 2% for newbie traders. When you get good and consistent and are making money and are profitable, then you can think about 2 to 4%. But 1 to 2% is where you should really stay, and I've already showed you what that previous chart, in fact I'll show you, is this one here is based on 2%. So if you don't think that's enough for you, then we have to rethink it. I mean, we got to, because it's important that you put in perspective how powerful these pips are. Okay, so how much do I risk? You determine that. Say, okay, I'm going to risk 2%. Determine stop loss size. Okay, this is key. I use about a 20 pip stop. I don't want to lose more than 20. So I try to keep my daily performance between -20 and +20. Just being able to keep it within that range takes some discipline. If you're trading and at the end of a few weeks you're either between -20 and +20, even if you're not profitable at first, just the fact that you're keeping it in that range is key. You're not letting it get away from you. Okay, if you can stabilize that and you can be confident in your ability to not lose more than 20, you can have confidence in weighting your account properly. All right, so I use 20 pips as my daily stop loss. I don't want to lose more than 20 a day. So if I don't want to lose 20 pips a day and I don't want to lose more than 2% or 20 pips, then guess what? I make 20 pips equal 2% of my account. And then I calculate my lot size based on my account size. So here we go. 20 pips is 2%. Okay, so once you weight it this way, and I'm going to show you the formula to figure it out. Once you weight 20 pips to equal 2% of your account, you can think about it. That means 10 pips is 1%. So every 10 pips you gain now as a trader, you're getting you're adding 1% to your account. You're saying 1%. I mean, we're talking about in minutes. If you make 15 to 20% in the stock market over the course of a year, you're a superstar. Okay, we're talking about 1% every 10 pips. If you make 100 pips a week, that's 10% a week. Okay, so you have to put this in perspective. Every pip is worth 0.1% of your account now. That means every pip is worth something. Okay, you may think 0.1, that's nothing, but over time, that is a huge amount. Okay, so there you go. We're going to weight our account to 2%. Now we're going to show you how to do that right now. Any questions so far? Okay, let's calculate our risk. All right, this is the formula for determining how many lots I can put on this trade for a 20 pip stop that's going to equal 2%. Okay, so here you do formula for determining proper lot size. Now this is based on a 20 pip stop and 2% risk. Say you want 30 pips and 1% risk, then you have to adjust your formula. This is all up to you. This is what I use, but I'm put it in a formula to where you can plug in your preferences. Okay, so 20 pip stop, 2%. Our account size multiplied by the risk, which is 2%, divided by 200. Now, this 200 is the dollar amount, basically, of one lot on 20 pips. So if you were doing a 30 pip stop, you would make this 300. So if you use a 20 pip stop, if you're going to use different figures, let me know. We can work it out for you, okay? But this is based on 20 pip stop equaling 2% of your account. This is the formula. Account size multiplied by risk percentage divided by 200. That's how many lots. So let's use the example of a $1,000 trading account. We take 1,000 multiplied by 2%, divide it by 200 equals 0.1. That's 1 mini, because the standard is 1. Okay, I'm going to move on to the next one. All right, here's a $5,000 account. Okay, 5,000 times the 2% divided by 200 equals 0.5, so 5 minis. If you've got a $5,000 account, you should be trading 5 minis. You should not be up to a standard lot yet. Okay, if you have a $10,000 account, multiply that by 2%, divided by 200 equals 1 standard lot, 20 pip stop. So, you're getting the gist here, I believe. Here, let's do one $500 account for those guys that, hey, not everyone can start with $1,000. Okay, so you need to be in a micro account. That's 5 micros on a $500 account. All right, starting to see our rule of thumb here. At 2% risk with a 20 pip stop loss, assuming a 20 pip stop loss, 2% risk, you can you can trade 1 standard lot, okay, per $10,000 in your account, or 1 mini lot per $1,000 in your account balance, or 1 micro lot per $100. All right, and I hope this is all making sense. This is just to kind of give you a ballpark idea. A lot of people think, I got to have 10,000 just to trade a standard lot. A standard lot's a lot, guys. It's a lot. You know, I know everybody wants to make $200 a day, and you might have a $5,000 account. You think, gosh, why can't I do that? Well, you can try, but that's 4% risk management, and you saw the first chart. I mean, the drawdowns can be. All right, so 2% risk. There's your rule of thumb. So let me take you through something here. So say you start with a $10,000 account, okay? Then you can trade with 1 standard lot. Now, say you're consistent, you make your 100 pips for the week, or 20 pips a day, 5 days, make 100 pips a week. So that 1 lot made you $1,000. Okay, now your account balance is 11,000. Well, guess what? Now you're not trading with 1 lot anymore. You're trading with 1.1 standard lots. You're trading with one standard and one mini, because remember the rule of thumb, one standard for every 10 grand, one mini for every 1,000. So the next week you're moving up to one mini. Now that same 100 pips makes you 1,100 that week, bringing our balance to 12,100. Now you can add another mini on there. Okay, you can do 1.2 or one standard and two minis. Now notice there's also an extra $100 that allows you to go up a micro if you have that capability on your account. So basically, it's good to have the lowest account size possible to give you this kind of exact compounding ability. So if keep a micro account if you can, or a mini account as long as you can. Don't go to standards unless you're trading like 10 standard lots or something. I would trade a mini account as long as you can. That way you can fine tune your risk allocation. So this is compounding. So and so on and so on and so forth. I'm going to show you a chart now that draws this out. But you can see how you can keep increasing your size as long as you maintain consistency. Here's a chart starting with $1,000. Okay, first week. Now I say 20 pips a day. What does that work out? 100 a week. You may not get 20 every day. You might have to like break it up. You might get 15 one day, 30 in a day. Who knows? The goal you might want to look. You're trying to get 100 pips a week. Now, if you can do that, 100 pips a week, look what we got here. At the end of 2 months, it takes about just under 2 months to double your account. Now, you know what happens if you take a penny and you double it every day of the month, double it 30 times, how much money you'll come up with? It's like $10 million. Double a penny every day for 30 days and you have like 10 million. So here, every 8 weeks, we're going to double. Now, check this out. This is starting with 1,000. Now, this is a perfect world, okay? You're not going to get 100 pips every week, and this is not to think that you can or will. This is to give you a concept of what a few pips in the positive can do today, and not to risk too much, because if you got a few and you don't see anything great, let it ride, because it's going to add up. If you can consistently make 100 pips over 48, now it's 52 weeks in a year, but I'm just saying for 48 weeks, that's basically 12 months, 4 weeks, you can basically almost have 100 grand in your account. Now, I'm not saying that this is what's going to happen for you, but if you were perfect, and no one is, this is what you could aim for. Now say when it's all said and done, you only average 75 pips a week. You're still going to multiply your account over 30 times in a year. Still nearly doubling it after 8 weeks. Say you only do the half performance. You only average 10 pips a day using the same weighting, though. You're still weighting it accordingly, but when it's all said and done, you're only averaging 10 pips a day. So say you had a few good days, 20, 30, but then you had a 20 hit, then another plus 15. At the end of the week, you made 50 pips. All right? If you can have a week like that every week, you're still going to multiply your account 10 times a year. That's 1,000% return. Of course, no one wants this when they're looking at this, okay? But you just got to keep it in perspective. All this is great. If you can do any on these, you are, yeah, exactly, moving to Costa Rica. All right, so this is a $1,000 balance. All right, let's look at what some other numbers can do for us. All right, here's a $5,000 balance. All right, you start with 5 grand, you can do 100 pips a week. And our Tiger Room is posting 100 pips a day. I mean, I think you can pull 20 from our room every day. You know, even when a moderator has a bad day, there's other traders to pick up from. You got over 10 moderators making live calls, and we're averaging over 100 pips a day. So I think you can get 20 a day out of that. So if you can start with a $5,000 account, you know, I don't even want to say the numbers, to be honest with you, but after a year of averaging 20 a day, you can have a severe income. But if you could only average 10 pips a day, you're still going to make 50 grand a year on 5,000 compounding. All right. Let's go ahead to the 10. Just we'll look at a 10,000. Got 10,000. You can do some serious damage. All right. So basically, what you're looking at, if you can compound 20 pips a day, you're looking at about 100 times account growth. If you can do it 75 pips a week, you're looking at about 30 times account growth. And if you can do about 50 pips a week, 10 pips a day, you're looking at about 10 times account growth. So that's the power of 20 pips per day